If you're new to trading options, then this video is for you. Welcome to the complete beginner's guide to options trading. And in this video, we're going to go over what are options, some of the important concepts and principles, and how you can go about trading options. So for this video, I'm going to use plenty of examples from the real market, and that will help to guide us along as we explore this topic. But do bear in mind that these are just for illustrative purposes. None of this should be taken as investment advice as to what specifically to buy and what specifically to do. So options, basically they are contracts to buy and to sell shares. And each of these options is a contract for 100 shares. These contracts are tradable on an exchange, so you can buy them, you can sell them using your brokerage account. And also their prices will fluctuate based on demand and supply factors. The last thing to note is that option contracts have an expiration date. There is a duration of time in which they are valid, after which they will expire. So there are two kinds of option contracts: the call option and the put option. A call option is a contract to buy 100 shares of stock at a certain price by a certain date. So let's take a look at an example. The share price of AMD is at $109. So let's say I think AMD share price will increase quite significantly, but I'm not 100% sure about it, and I don't really know if I should buy 100 shares of it today. So what I can do is I can buy a call option. So let's say I buy a call option with a strike price of $110, 3 months to expiration. So basically it means that in the next 3 months, no matter how high AMD share price goes, right? 120, 150, 200, 300, 500, regardless of where it goes, I have the rights to buy AMD at $110 anytime in the next 3 months. And if I'm wrong and AMD does not increase, then I don't need to buy the shares. Because I own the call option, I have rights, but I have no obligation. As long as it's not favorable for me to buy the shares, I don't have to buy them. So this sounds like an awesome deal, right? No matter how high the share price goes, I can always buy it at a cheaper price, at a fixed price. Even if it goes down, I don't have to buy the shares. I'm not obligated. So what's the catch? Well, the rights do not come free. To buy the rights, I'm going to have to pay something. So what I pay is known as the premium. So if my prediction is correct, AMD share price increases, and I say, okay, I want to buy the shares at 110. The seller of the call option has the obligation to sell me the shares, regardless of how high the share price goes. Because I have the right to buy it from him at 110, he must sell it to me for $110. So that's basically how a call option works. It gives the buyer of the call option the rights, but not the obligation to buy shares at a fixed price, a strike price, and the rights are valid for a limited period of time. Now, what if I think that the share price of AMD is not going to go up, it's going to go down instead? I want to benefit from that downward movement in AMD share price, but I'm not 100% certain about it as well. So in this case, what I can do is I can buy a put option. The put option will allow me for a fixed period of time to sell shares at a fixed price. So let's say I think that the share price of AMD is going to fall, right? And sometime in the next 3 months. So what I can do is I can buy a put option with a 3-month expiration at a strike price of $105. So if I'm correct, no matter how low AMD share price drops, I can sell it at $105. So let's say it drops to $100. I can go to the market, buy the shares for $100, exercise the rights to sell them at $105. Even if it goes to like $90, $80, $70, I can just buy it at the market for like whatever price it dropped to, and then sell it for $105. So to buy the put option, I will have to pay a premium to the seller of the put option. The seller of the put option is obligated to buy the shares from me at the strike price, in this case $105. So if I'm wrong, if the share price doesn't fall, if it stays above 105, I am not obligated to sell the shares at $105. So this is how put options work. It gives the owner of the put option the rights, but no obligation, to sell the shares at a fixed price, a set price, for a limited period of time. So for the purpose of this video, I'm going to be using the Tastyworks trading platform, but the options chain on pretty much any brokerage platform that allows you to trade options is going to operate in pretty much the same manner. So first and foremost, these are all the options that are available for trading. These are the expiration dates of these options. So all of these options will expire on December 17, which is 101 days to expiration. These are 73 days to expiration. These are 500 days to expiration. So in the middle here, these are the days to expiration. So for stock options, there are two kinds. You have the regular and the non-regular options. So regular options just means that they expire on the third Friday of every month. So they're also known as the monthly options. These are regular options. Then you also have the non-regular options, which are weekly options. So these expire every Friday. Regular options are more commonly traded. So I think you will find that there's more volume and more liquidity when it comes to the regular options. Personally, I use both. It just depends on what strategy I'm using for that particular trade. Okay, so for this example, we're just going to be using the regular expirations. So remember, in our example, we were looking at options that expire in 3 months. So the closest is the December 17, the 101 day option. That's the closest to 3 months. So let's take a look at the options that are available. So here you can actually select the number of strikes, the number of options that you want to trade. But I'm just going to look at 16 strikes for this example. On the left side, we have the call options. Remember, these are the options contracts to buy 100 shares of stock. On the right side, we have the put options, which are the contracts to sell 100 shares of stocks. And then in the middle, we have all the strike prices. So just now in the example, I was talking about buying a call option with a strike price of $110. So call option, $110, 3 months to expiration. This row corresponds to that particular option. And then in the second example, I talked about buying a put option in AMD at the strike price of $105, 3 months to expiration. That will correspond to this particular row. This center line represents the current share price of AMD. The current share price of AMD is $109. So if I own any one of these options, I actually have the rights to buy AMD at a cheaper price than the current market price. If I own the 95 call option, I can buy AMD for $95 even though it is worth $109. So any of these options that are above the middle line are known as in the money call options. So for the call options that are on the bottom side of the center line, these are known as out of the money call options. So if I own any of these call options, I have the rights to buy shares at these prices, but they are not better than the current market price. On the put option side, if I own any one of these options, I can actually sell shares at a better price, a higher price than the current market. So if I own a $120 put option, actually I have the rights to sell shares for $120, even though the market is only 109. So these are known as in-the-money put options. So these put options are known as out-of-the-money put options. If I own any of these put options, I have the rights to sell shares at these prices, but they are not better than the current market price. So the options with the strike prices that are the closest to the current share price, this is known as the at-the-money options. So the options premium is made up of two components. The option has intrinsic value and the option also has extrinsic value. So this brings us to the next section where we're going to talk about the value of the option contract. And we're going to start out by talking about the intrinsic value. Intrinsic value is the value of the option contract if we were to exercise it today. Let's look at the call option for the strike price of $90. So AMD today is worth $109. But if I own this call option, I have the right to buy AMD for $90. So I can buy it at $90 and sell it in the market for $109. And that will give me a profit of $19. So this is the intrinsic value of this particular option contract. What about an in-the-money put option? So let's just pick at random the 120 put option. If I own the 120 put option, I have the right to sell the shares at $120. So I can go into the market now, buy the shares for $109 and sell it for $120. So that gives me a profit of $11. So for in-the-money call options, the intrinsic value is the current market price minus the option strike price, the rights price. For put options that are in the money, the intrinsic value is the put option strike price minus the current market price. So because out of the money options don't allow you to buy or sell shares at a more favorable price, therefore they have no intrinsic value. Their intrinsic value is 0. Wow, doesn't this sound like an amazing deal? If we buy in the money call options, we can always buy shares cheaper than the current market. If we buy in the money put options, we can always sell shares above the current market. Isn't that fantastic? So let's go and buy one now. I'm going to buy the $90 call option. I will straight away make a profit of $19. That sounds really awesome. Let's do it now. So let's see, how much will I be paying for this option? What? $21? Well, that is because there is another component in the options price known as the extrinsic value. So the extrinsic value is made up of two components, time and volatility. Option contracts have an expiration date. There is a limited amount of time. If I think the share price of AMD is going to increase, if let's say I buy the call option that has 3 months to expiration, I have 3 months to be correct. If I buy the option that has 1 week to expiration, I only have 1 week to be correct. If I buy 1 year to expiration, I have a whole year for my thesis to be correct. So the more time I have to be correct, the more expensive the option is going to be. So let's look at the options with a strike price of $110. The option that is going to expire in 9 days, it is worth $2. The option is going to expire in 3 months is worth $9, whereas the option that's going to expire 1 year from now is worth over $18. So the longer time is given for my thesis to be correct, the more expensive the options are going to be. So because option contracts have expiration dates, as the days go by, as the weeks go by, the time value of the option contract will erode away with time. And this is what is known as time decay, data decay. All option contracts will experience a decay in its time value. And ultimately, this time value will be 0 when the contract expires. So extrinsic value is made up of time and volatility. The volatility is a measure of the expected movements in the share price. So to illustrate how volatility makes a difference in extrinsic value, we're going to compare the option contracts on two different shares, Salesforce, CRM, and we're going to compare CRM with Upstart Holdings, UPST. Very, very similar in price, 265, 262, it's pretty much the same price. For the purpose of this comparison, let's just say we're going to use the put option with a strike price of $260, 3 months to expiration. And so let's take a look at the option price. Alright, so this is the options chain for CRM. We are going to choose 100 days to expiration, 260 put option. We can see the price of the put option is around $13.15. So now we're going to go over to Upstart Holdings. 100 days to expiration, about 3 months to expiration, 260 put option. It is $42.30. So these are put options with the same strike price, the same time to expiration. But for Upstart Holdings, the option price is more than 3 times that of CRM. And this is contributed by volatility. So if we use this indicator called the average true range, ATR, it kind of measures the average daily move of the share price. For CRM, the ATR is at $5.50. And for Upstart Holdings, the ATR is at $14.50. So the average price movement for Upstart Holding is 3 times that of CRM. So Upstart Holdings is a far more volatile stock than CRM, and this volatility is reflected in how the UPST options is far more expensive than the options for CRM. So a stock that has more volatility generally is expected to make larger price movements compared to a stock with less volatility. Upstart Holdings is a far more volatile stock than CRM. The prices tend to make larger moves. The option prices in Upstart Holdings are also more expensive, way more expensive than those of Salesforce. So where in the options chain can we see the volatility? So if you look over onto this side of the option chain, you will see some of these numbers. So what do they mean? IVX is basically the implied volatility of the option. The higher this percentage number, the more volatile the option. So as you can see, for Upstart Holdings, the numbers are around like 80%, 70%, 60%. You come over to CRM and they are much lower, 20%, 30%. So this gives an idea of the general volatility, implied volatility of these options. This number is the expected move. So the algorithm is predicting that CRM can increase by $6.50 or it can fall by $6.59 over the next 9 days. But it's just a statistical algorithm prediction of the potential movement of the shares. The larger these numbers are, the higher the option prices are going to be. By the time the option expires, volatility will be equal to 0. However, because volatility is a measure of the expected movement in the share price, it can fluctuate on a day-to-day basis and not necessarily will be decreasing in a linear fashion. When the option contract reaches its expiration day, all its extrinsic value, time value, volatility, all of it will decrease down to 0. To summarize everything up to this point so far, the buyer of the call option basically has the rights to buy 100 shares of stock at a certain price known as the strike price for a specified amount of time. Put options are contracts that provide the owner of the put option with the rights to sell 100 shares of stocks at a certain price, known as the strike price, for a limited period of time. So call options are in the money when the owner of the call option has the rights to buy shares at a cheaper price, a better price compared to the current market price. Put options are in the money when the holder of the put option has the rights to sell shares at a higher price, a better price than the current market. Options are out of the money when, the rights don't allow you to buy or sell shares at more favorable prices compared to the market. The option contract that's the closest to the current share price in the market is known as the at the money option. The intrinsic value of an option contract is how much the contract is worth, how much is its value if it were to be exercised today. For in-the-money call options, the intrinsic value is equal to the market price of the shares minus the strike price. For in-the-money put options, the intrinsic value is equal to the strike price of the option minus the current market price of the shares. Out of the money options do not have any intrinsic value. Extrinsic value is the difference between the option price and the intrinsic value of the option. It is made up of two components. Time value is the value of the option that's attributed to the amount of time that's left to the expiration. Time value will decrease as the option approaches its expiration date. When it reaches the expiration date, the time value will be equal to 0. Volatility is a measure of the expected magnitude of the share price movement. As volatility increases, the extrinsic value and the option prices will also increase. At expiration, volatility will also fall to 0, but volatility can fluctuate quite significantly before the option expires. How do we buy and sell options? So we go back to our example in AMD, and I want to buy the 110 call option 3 months to expiration. So before we continue, why are there 3 different prices and which one of them do we use? So let's talk about what is the bid, the ask, and the last price. So bid and ask, the mechanism works the same as though you are bargaining for something. So let's say I want to buy this cushion and I go to the cushion shop, right? And I ask the cushion shop owner, how much for this cushion? I give you a good price, $10. $10, very good. I will not accept anything less than $10. What? No, the most I'm willing to pay for this cushion is $5. So the bid is the highest price that buyers are willing to pay in order to buy this option, and the ask is the lowest price that the sellers are willing to accept for selling this option. So last basically is the price that the option most recently transacted at. So if I want to buy this option, I will click on the ask price. Let's take a look at the potential outcomes of this trade. We can come over to the curve tab. So what we see here is what is known as the options payoff diagram. This shows us what profit or loss we can make from the trade based on where the share price is when the option contract expires. The horizontal axis is the share price of AMD, and the vertical axis is the profit or loss from this trade. If the share price of AMD falls or even remains the same, my option will be losing money, and this is because I have to pay a premium for this particular trade. The premium is the maximum loss on this trade. Even if AMD shares fall to 0, the maximum that I will lose is the premium of $9 that I will pay for this trade. If the share price of AMD increases, my call option contract will become profitable. The maximum return is theoretically infinite, because if AMD goes to like $200, $300, $400, I have the rights to buy it for $110. The upside potential is basically limitless. Because I already paid the premium for the call option, in order for me to make money on buying this call option, AMD has to increase above $120. So let's take a look at the payoff diagram for the put option example. I could buy the 105 put option. Let's take a look at the payoff diagram. I will make money when AMD shares fall, and they have to fall below $97.50 in order for me to be profitable. If the share price of AMD remains the same or increases, then I will be losing money on my trade. However, because I buy the rights and I have no obligations, the maximum that I will lose is the amount of premiums that I paid to buy the put option. Realizing our profits and exercising our options. I expected the share price of AMD to increase, so I bought a call option, $110 strike, 3 months to expiration. So anytime in 3 months, if AMD share price increases, no matter how high it increases, I have the right to buy it at $110, and I paid a premium of $1,000. Because the current price of AMD is $109, the intrinsic value of the option right now is 0. All of the $1,000 is extrinsic value. 1 month later, the share price of AMD increased to $130. Wow! So now I want my money. So what can I do to realize my profits? So how much is this option worth today? The intrinsic value of the option is the value of the option if it were to be exercised today. If I exercise my option, I will buy 100 shares for $110 and I'll immediately sell it for $130. So that's $130 minus $110 times 100 shares. So that gives me a profit of $2,000. Now, because the option contract is 1 month closer to its expiration, the extrinsic value has shrunk. So let's say the extrinsic value is now $200. So today, the option contract's worth is the intrinsic value plus the extrinsic value, and that is $2,200. Now, if I were to exercise the option, I buy the shares at $110 and I sell them for $130, and my profit will be $2,000. Great, right? Wrong. Never exercise your options. When we exercise the call option is gone. And what this means is that I have lost whatever extrinsic value is left in the option. Now remember, options are tradable on an exchange and they can be bought and sold at any time. So what I should be doing is I should just sell this call option away and I will receive proceeds of $2,200. By exercising the option, I will actually forfeit whatever extrinsic value is left. So remember, never exercise options. Why do I trade and invest using options? And why do I think that you should learn to do so as well? The first reason is the multiplier effect. When I trade options, I'm trading the rights and obligations to buy and sell 100 shares of stock. And because the premiums, the prices of options, are just a fraction of the stock prices themselves, if I'm right, I am just using a smaller amount of my capital, and I can generate the equivalent returns as though I'm holding 100 shares of stock. So this allows me to have a much greater efficiency on my capital because I'm allocating smaller amounts to each of these strategies, and it allows me to also have a more diversified portfolio. However, the multiplier effect can also work to my disadvantage. Because if I buy options and I am wrong, when the options reach the expiration date, their intrinsic value will be 0. Their extrinsic value will be 0. And I will lose 100% all of the capital that I invested into buying those options. The second advantage, the second reason is that I can use options to manage my risk. In the worst case scenario, if AMD falls to 0, if I had bought 100 shares, I would lose $11,000. However, if I had bought the call option, my maximum loss would simply be the premium that I paid for this call option, which was $1,000. Using options can help me to manage my risk, can help me to limit my losses. The third advantage of trading options, we have learned how extrinsic value of an option contract will fall to 0 on its expiration date. So with that in mind, I can actually generate a regular recurring stream of income, selling out of the money options. Do check out some of my option strategy videos for more information on these income generating strategies. I will be posting more of these as time goes by. So make sure you are subscribed so that you don't miss out on these exciting content that I'm preparing for you. The fourth reason is that trading options really opens up strategies and the variety of things that you can do to invest in the market. These possibilities actually allow us to make returns in far more scenarios compared to just simply buying or selling shares. Because there's so many dimensions to options, we've only barely scratched the surface in this video. There are a lot of things to learn, and thankfully with technology, with the internet, with YouTube, a lot of this information is actually very easily accessible and very easily available today. That's it for today's video. I hope it was helpful for you. I hope that you have gotten a good introduction, a good overview into what are options and what is options trading. So do leave a like, do leave a comment. I want to know what things you would like to learn, how I can help you in your investing journey. So if you're interested in learning about options trading, you're interested in learning more about investing, do subscribe to the channel, hit that bell notification button so you don't miss out on the exciting content that I have just for you.